Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500 that still remains very high off its low here. Since the 17th of June, we've had really a relentless run on the market here, 14% off its low after 6 consecutive months of bad news after bad news, a very powerful tightening narrative from the Federal Reserve, surging inflation, yield curve inversions throughout the last few months, and leading economic indicators that are starting to point down. It really doesn't seem like the market could ever really come out of this correction. In fact, if we take a look at this chart here, it seems most market participants are aligned with that. This is a chart from the Bank of America Fund Manager Survey that essentially highlights risk-taking in the market. And you can see here, July 22, we're seeing the lowest amount of risk-taking ever. Right, this chart starts in 2001, I believe that's when the survey started, and we have never seen a reading this low. The only comparable reading was October of 2008, which wasn't the low in the market, but it was definitely closer to the low than it was to the all-time high. We had seen the majority of the bear market behind us by October 2008. The market was down 45% from its highs. Now it did proceed to go down another 25% from that level. So, that just adds a little bit of context, but it does go to show you that we have seen a huge amount of pessimism in the market, a lot of concern, and a very, very rapid shift in the concern as well. You can see risk-taking went from extremely high in 2021 to extremely low in 2022. Now, while there are many measures of risk-taking and sentiment in the market, as a general rule of thumb, a strategy that we like to use is going against the consensus, going against what most people are doing. That's usually when you have the best deals. And unfortunately, that's not easy to do because that comes at moments where there are a lot of concerns. In October 2008, it was very, very difficult to see that you were going to see a 12-year bull run following that drop. The stock market dropped for a reason here. Things were collapsing here. Unemployment rate was rising massively. Big banks, big corporations were going bankrupt, and a massive part of the economy was on the verge of bankruptcy. Not just a couple of banks, a complete collapse of the financial system. So it's quite ironic to see that risk-taking is at comparable levels. Now, of course, I'm oversimplifying things here, but I do think that illustrates the current situation pretty well, and that this dip here has been and still is an opportunity if those headwinds that we saw in the first half of 2022, all of a sudden they start to dissipate. They don't seem as serious anymore, and so that lets investors take on more risk, which really isn't very difficult to do considering the starting point. Now, of course, after a 14% move up here, you could argue that this is not the most favorable entry point. We're going to discuss that in just a second. But if we do try to imagine a brighter future, what would that look like? It would come in the form of treasury yields stabilizing, right? And I can add here the 10-year yield and the 30-year yield that really caused this entire move down, caused this entire panic. You can see here the orange and blue line rose very, very aggressively as the Federal Reserve was really getting more and more hawkish. And since that high in June here, they've come down. And as a result of that, stocks have rallied. So this is really not a market rally that's based on strong growth or earnings expanding like it was in 2021. This is really a rally that's based off easier conditions. And in fact, you can clearly see that on this chart of forward PE ratios of the S&P 500. This is what has really moved the market around for the last 6 months. We saw a dramatic decline in valuations as we saw yields rise. And ever since that June low, we've had a recovery in those valuations. So this is really based on the economy cooling down and slowing down, inflation peaking, the economic activity cooling down, growth slowing, and that could help push the market higher. However irrational that sounds, this would really not be the first time in history where we have that type of setup. And One example that I like to give is 2019, where you really did have that phenomenon where yields were moving down based on growth slowing, economic activity that was moving down, manufacturing PMIs that were printing lower than expected numbers. That was causing financial conditions to ease, the expectation of the Federal Reserve to begin monetary easing to increase. And so people started to get more bullish. People started to take on more risk. So that's what a brighter future would look like from a macro standpoint. Now, it's very difficult to predict exactly what's going to happen, but that's the gist of it. Now, one of the big risks that we're currently watching out for is that we don't get this slowdown and that the economy actually ends up holding pretty strong. And if we take a look at the unemployment rate, we recently had a better than expected unemployment print here at 3.5%. So it does suggest that there's a very strong labor market, right? The strongest labor market that we've had since the 1960s. So it's a very interesting market environment right now where you're seeing, on one hand, a lot of economists do suggest that we are indeed in a recession. And then on the flip side, you've got economists saying that apart from the GDP prints, we're seeing none of the typical signs that suggest we are in a recession. And if you've been a member at gameoftrades.net, you'll have seen this chart here that essentially explains that phenomenon and the very weird market environment that we're currently in, where typically when you see real spending on goods decline, as we did throughout 2022, that leads the economy lower, and that's typically accompanied by a rising unemployment rate or rising initial jobless claims, right? You can see that 2008 here, a decline in spending. The vast majority of the time, they diverge, right? And what we saw here throughout 2021 and 2022 is that they went down together, meaning that real spending was moving down and the unemployment rate was also moving down. So that tells us that this is not a typical slowdown. It's not a typical cyclical recession. This has actually just been a rebalancing of spending on goods. People spent too much during COVID, and so they pulled back on their spending throughout 2022. But that's just because they had too much stuff. It wasn't because they were losing their jobs. So that's actually one of the risks that there is to the bullish thesis on the market right now, is that the economy actually ends up being very, very strong in the months ahead. And I'm going to quickly show you why that's important by showing you the 2-year yield and show you what happened here on this day following that unemployment number right here. You can see what happened to the 2-year yield. It jumped up 9% in one day. That's a massive move, right? So the reason that happened is because the 2-year yield essentially anticipates what the Federal Reserve is going to do. That's what the most basic explanation of what the 2-year yield is. It's the anticipation of Fed policy. And if we put the Fed funds rate on top of this chart, you can see the 2-year is generally pretty accurate at predicting what the Fed is going to do. And so when you have a very strong labor market and you have very strong numbers like the one we got last week, that makes the market expect the Fed to be more hawkish. And so that really goes against what the bullish thesis on the market right now is that we need to see rates steadily move down. And again, I'll give you that example of 2019. In order for valuations to expand like they did in 2019 here, you need to see the 2-year yield move down, which is essentially the equivalent of seeing monetary easing. So if the economy continues to be stronger than expected and continues to print these very good numbers, and inflation actually doesn't stop running hot, what's going to happen to the 2-year is going to continue rising here. It's going to continue rising to 4%. And that big headwind that really essentially caused the entire correction in 2022, which was the tightening of financial conditions, that's going to continue. And you're going to see the market continue moving down. So, I mean, that's not a prediction. We're really just walking through these developments and to give you guys the entire picture, give you guys all the information you need. But from what I see from the rise in the 2-year that we got here, that's a form of monetary tightening. And you could see the market get a little bit concerned by that. And so instead of a V-shaped recovery like you had in 2018, 2019 here, which essentially reflected the V-shape that we had on the 2-year, well, you could instead see a little bit of a period of accumulation and a topping pattern on the 2-year. But if the economy continues to show signs of slowing down and we go from an environment where inflation never stops to surprise to the upside as we've had throughout 2021 and goes into an environment where we actually see deflation, disinflation, and CPI prints actually begin to surprise to the downside, that would trigger a pretty rapid reversal in the 2-year yield and increase the likelihood of seeing that V-shaped recovery on the S&P 500. And our strategy at gameoftrades.net is not based on one scenario happening over the other, but from the research that we have so far made, it does look like the potential for inflation to start surprising to the downside is very elevated. And if that's the case, that's going to be a big wall of worry. That's going to be a big wall of worry that the market can start to climb up. And that's really what can trigger those types of V-shapes in the market. We don't want to trade through these day-to-day moves because that can be incredibly tough to time. You don't know what's going to happen. But in the grand scope of things, we can take advantage of those very attractive risk reward, right? Our service is really aimed at helping investors capture the broader moves in the market, not the short-term volatility. And that's why I really don't want to say that there's a short setup right now, because in general, we're pretty bullish on the market. We think there's a real reason to be optimistic on the market right now, but we're not pretending to know the exact path that the market is going to take to get there. And this is really something that we always try to do, because if you're too focused on the day-to-day price action, you're going to get caught up. You're going to start to panic instead of actually taking advantage of those very oversold readings, for example. And those types of oversold readings really come on the worst days, right? This was from the June 16th article that we posted, where we had that extremely oversold reading following that big CPI reading that just tanked the market down very rapidly. That was just a massive, very, very rapid move down in the market. And when that kind of opportunity happens, similar to March 2020 or right here, October 2008, you want to be taking advantage of those opportunities, however contrarian those may seem. So that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to smash that like button. Also, don't forget to click on the subscribe button if you are new here and you want to learn more about the market. Now, in the meantime, I wish you good luck on your trading and see you next time.